What's up guys, it's Mikhail here from the Results Trade. Welcome to part 3 of the Guide to Trading Strategies.
You're now tuned in to the Desire to Trade podcast, a show where we bring you the best figures of the trading world and teach you how you can become a successful trader. This is your host, Etienne Crete.
Originally, I wanted to record all these episodes in a week, but I couldn't record the last part. So today I'm coming up with the third part of the Guide to Trading Strategies. In this third part, I want to cover trend trading strategies because I know a lot of people are wanting to trade in trends and it's something that can be profitable if you know how to do it. I want to say I'm not a super trend trader, it's not my specialty, but I do want to highlight the basics of it so you can maybe go further in that route. And then I want to cover a few things that you need to combine with any trading strategies, because any good trading strategy cannot necessarily work all the time. So you need to make sure to have some rules with it to make sure that you follow the market and don't decrease your win rate too much, or don't decrease your winning trades too much. So we'll cover that in the end. The first thing you'll want to do before trading a trend trading strategy is going to be to determine whether there's really a trend or not. That's the first step. So how to know if there's a trend? Well, you look at the highs and the lows. If you make higher highs and higher lows, you're in an uptrend. You need to have both, higher highs and higher lows. If you make lower lows and lower highs, you're in a downtrend. But again, you need to have both. Now, once you've determined this, you want to classify the strength of your trend. Is it a strong trend? Is it weak? Because that's going to help you determine how aggressive you have to be in your entry. Some people are going to trade only some sort of trends, like the medium one or the strong ones. Some people are going to trade all of them, but you need to define what type of trend it is. Because you cannot employ the same method in a weak trend as in a really strong trend. Then you can employ the same method I talked about in the last episode, the process I follow. Because the first thing you need to figure out when you're in a trend is a zone where price is likely to continue the trend. Now, how can you do this? Well, look at the chart and you have several ways. Price could go back to a structure point, price could bounce off a moving average, or price could simply pull back and bounce back. So you need to figure out and determine in advance what you're going to use to define the structure point where price could bounce. And price could even go to a Fibonacci retracement. Now, once you figure out the level, what you want to do is you want to look at price action. If your pullback is too strong in your trend and it's breaking the trend, you might as well not take it. But if you keep staying in the trend and you have good evidence that price could go back up, then it's up to you to decide how you're going to enter the trade. I know people who trade pullbacks without any confirmation. If they know that price coming back to their level, they're just going to enter the trade right away, put a stop loss that's appropriate, quite far from the structure point, and they will just get in the trade that way. That's possible. The other possibility is that you wait for price action to confirm the trade. So if you have some sort of price action pattern or candlestick pattern, such as a hammer, an engulfing candle, or any type of signal that increases the probability of the price going back up. Now, as always, you have to test this by yourself, but you need to figure out if you want to use confirmation or just enter right away. There are going to be a lot of factors impacting how reliable the trade is going to be, and that's going to help you determine if you should enter without confirmation or with confirmation. And I try to cover those as much as I can in the academy, so it's something you can definitely check out. But for now, it's important for you to define something and to stick to it. Now, there's a couple of indicators that can help you in trending markets figure out how strong the trend is and where to enter the market. We've covered those that are going to tell you location to enter, but there's a few things that you could consider to figure out how strong the trend is. One of them is called the ADX, the Average Directional Index. This is going to tell you what strength the trend has. Is the trend strong? That means the ADX will be above 25. Or is the trend weak? That means the ADX would be probably between 20 and 25, and below 20 would be there's no trend. It's sideways. That can really help you determine how strong the trend's going to be and what you can expect from the trend. Usually the ADX is calculated over 14 periods. That's the default, but you can change it depending on your style, for sure. The RSI can also tell you how strong the trend is. According to Constance Brown, the author of Technical Analysis for the Trading Professional, the RSI is going to help you determine whether we are in a bear market or a bull market. The rules are pretty simple. In a bear market, the RSI is going to gravitate between the low of 20 and 30 up to 55 to 65. And then if you're in a bull market, meaning in an uptrend, the RSI is usually going to go between 40 and 50 to the upper limit of 80 and 90. That's going to help you determine how strong is the trend. So, in short, if we're at the top of the range of the RSI most of the time, we're in an uptrend. If we're in the lower limit of the RSI most of the time, we're in a bear market. That's going to help you determine easily what the price is doing. Now, it's important for you to remember that the RSI is working better in sideways market. It's not made usually for trends, but it's something you can use just as a kind of a snapshot to look quickly at. Then I want to talk a little bit about moving averages. Those are really used in trending markets, but people don't always expect the right way for moving averages. You can use them either as a dynamic support or resistance level. That means price is going to bounce off the moving average. Or you can use them for crossovers. Crossovers are really popular, but you need to remember that the winning rate is usually going to be really low, between low 30 and 50% at max, because you will often have to scratch trades when the market shows a crossover but does not start a trend. The good thing is that once you're in a trend, you are usually going to catch big moves. And that's the basic of those crossovers. Now you do want to test this because not all moving averages are working fine in crossovers. So you definitely have to check that out, depending on what you're going to trade as well. If you're going to use moving average for crossovers or as bouncing areas, you want to make sure that you look at alignments. That means you look at different time frames and make sure that everything aligns. That's going to give you a much better probability of your trade working out when everything is aligned. So the daily chart could be trending upward, the 4-hour chart is going to be upward, the 1-hour chart upward, and you would enter maybe on a 30-minute chart or the 1-hour chart. And that's going to give you a good reward to risk and a good probability of your trade being a big move. It's also important to consider different periods of moving averages, because one moving average is going to help you determine a trend, but you want to consider many to make sure that your trend is strong on different time frames. And that's where the importance of having a short-term, medium-term, and long-term moving average count. So you could have a 20, 50, and 200 moving average if you want, to give you a short, medium, and long-term picture of the market. Now there's a question that comes back all the time with moving averages. What type should you use? Because you know that there's a lot of types of moving averages. You have exponential moving averages, simple moving average, smoothed moving average, and weighted moving averages. Now, there's no rule here, and you have to decide what works best for you and what you prefer. But the EMAs, so exponential moving average, are usually going to fit better to price. But the simple ones are usually going to be the main ones that most people watch. So both of them will make price react in a different way. You also want to test your period, as always, because that's going to help you determine what you want to use. But don't forget that overall, the process is the same. Identify which phase of the market you are in, figure out where you want to enter, whether that's a Fibonacci zone, a moving average, or anything like that. And then figure out what you need to enter. Do you need to have a price action signal? Do you need to have confirmation with an indicator? And that's usually how you trade for anything. That's what I do for pretty much anything I trade. So if you can just have the process and write it down, you're going to have definitely an edge over most people. And then you want to test it, right? It's something people don't do, But if you can test your strategy and put it on paper, you're gonna make a huge step forward. So you want to do that quickly. And I do want to finish with a few things that people forget to consider. So there's this always big debate between fundamental and technical trading. And I said a couple of times that I trade purely technical. I don't analyze the news, I don't think about economic data. But there's a major point here that I want to highlight. Whatever trading you're going to do, you need to be aware of the news. I'm not going to enter a trade on a lower time frame if I know there's a news coming up. And if I know there's a speech coming up, I won't even enter on a higher time frame because I know how volatile it can be. And the first step in any trading I do is to check the news because I want to make sure that I have a chance of entering that trade without being stopped out for no reason. Because that's the first step. You need to be aware of the news that are coming up. Then the other thing that you could implement is to take partial take profits. So instead of taking all your profit at one zone that is far, why not taking some profit before, like at 1-1, and then the rest at 2 or 3-1. Or you can use also levels on the chart that you identify. And you take some profit at the first support or first resistance, take the rest of the second support or second resistance. And that's going to help you lock in some profit to make sure that you don't lose a lot of trades. And it's also going to help you stay longer in the trade sometimes. Because we're often tempted to close the trade early. We want to get out. We want to make sure we don't get stuck. But closing part of the trade and breaking even is going to help you staying longer in that trade. And just enduring leaving the trade open. This is something you can do. And I have a full article on my blog talking about this in details. So I think we've covered a lot over those 3 episodes, the 3 parts that we did. First one was about an introduction to the market phase. The second one was about trading strategies for a sideways market. We talked about breakouts and reversals. And in this episode, we talked a little bit about trending markets and a few things to consider as well to make sure that your strategy is strong. I do want to remind that if you have any question, just check out the Facebook group and feel free to ask me any question you have about this. Go on desirettotrade.com/group and you'll be redirected straight to the Facebook group. And if you want to get a good overview of this on video, go on desirettotrade.com/lesson. I prepared a special lesson for you guys talking about the market phase and how you can implement it simply in your trading. This is something that I offer as a welcome offer, and you guys will definitely get something out of it. So check it out on desirettotrade.com/lesson. As always, guys, it's a pleasure to bring you this podcast. And if you have any topic of podcast you want me to cover, feel free to reach out and let me know, because I want to do my best to bring the information that you guys need. I know how interviews are good, but podcasts with some information as well are helpful sometimes. So if you have any topic you want me to cover, any details you want me to bring, I will be happy to bring them and happy to give you more details about this. And if you've enjoyed the podcast so far, please leave a review on iTunes or Stitcher or whatever platform you're listening this on, because this is helping me reach more people. And the more people we can reach, the better we can make an impact together on other traders. And that is my absolute goal here. So on that note, I want to thank you for being here, and I'll see you in the next episode of the Desire to Trade podcast. Ciao.
Thanks for listening to the Desire to Trade podcast. To get all the information on this show, free articles, and unique resources, make sure to check out www.desirettotrade.com and subscribe. Please leave us a review and let us know what you thought about the show. It's time to become the best trader you can be. See you next time.